Okay, let's turn back to the global energy crisis as it's playing out, certainly playing havoc with markets at the moment. Let's chat to Trent Primmer from Barclay Pearce Capital for insights. Trent, good to talk to you this morning. So in fact, just taking a look at what's going on as far as, we're certainly talking carbon at the moment, aren't we? And the problems we're having with the energies because it's gas, it's oil, it's coal. In fact, we did see a decline in European gas prices overnight. That was on the prospect of some more supply coming from Russia. Overall, though, how are you seeing the tightness, in energy markets at the moment?
Yeah, I think one thing that we've noticed in particular, I mean, the pressure behind the coal price rising higher, a lot of that is from formerly China banning coal and now starting to backtrack on that ban as they've suffered sort of rolling blackouts and power outages. There's considerable demand, like you said, for LNG and coal. I think short term we consider the supply weakness to sort of be pushing the price higher. And obviously you're going into winter months in China and basically the Northern Hemisphere, essentially in general, where 90% of the world's population essentially lives, pushing those prices a lot higher. So we've seen coal, LNG, oil, everything that you can poke a stick at energy-wise, reaching pretty dizzying highs. So I think we're going to see some really, really strong numbers out of those three commodities in particular moving forward. And I think we'll see it through probably to the December period.
Trent, just put this in perspective for us, because we know in Europe clearly there is that pivot away from fossil fuels to renewables, and that is putting pressure on those energy prices at the moment. But overall, the world's energy is still relying heavily on fossil fuels.
Correct, yeah. 80% of the world's energy is fossil fuel backed essentially at the moment. I think with supply for things like coal and oil, it's getting hard to find investment and more supply as a result, particularly in an ESG focused world. It's stunning supply growth from greenfield operations. Long-term demand for these products will probably drop to zero, but we still have a long way to go, obviously, to reach that goal. And I think elevated fossil fuel prices are here for the long term due to restriction in supply, while obviously demand's tapering at a slower rate. But yeah, like you said, world still relies on it. Probably not the most most popular, but it's going to take some time to taper off that demand.
All right. Yep.
That's our view.
So, as a consumer, perhaps we should prepare for higher prices. However, as an investor, there are opportunities clearly in this space. What are you seeing at the moment, particularly locally?
Locally, look, we do like oil currently. OPEC's obviously increasing supply by about 400,000 barrels a day into November, which is marginal to say the least. I think some of the local names, Woodside Petroleum, which has some of the strongest and largest exposure to high quality LNG, and obviously their oil component. So we do like Woodside sort of short to medium term, and we also like Beach Petroleum, probably in the comparable smaller cap, but we think it's got legs from here. So those are the two picks, namely for oil we're aiming for at the moment, and obviously Woodside with the LNG exposure.
Trent, obviously, as we started there, coal also an issue at the moment, particularly in China as they're trying to source supplies. In fact, there are reports that they're turning back to Australian coal because they're pretty desperate at the moment. Of course, that's a political issue that they're dealing with too. So are you seeing perhaps some opportunity as far as those coal companies are concerned?
Yeah, look, I think probably in Whitehaven there's an opportunity, and some of the smaller players. I suppose from our company's perspective, we're really taking this rise in energy prices as a way to invest in companies with LNG and oil exposure. even though 80% of the world's energy is fossil fuel backed, a lot of the companies that we back right now, and a lot of the companies that we're focused on, are in the early to seed stages of renewable energy and green hydrogen. So we tend to move more with where things are going, rather than something like coal, which is, obviously there's going to be high demand, but that demand's going to taper off longer term. We'd rather stick with something like your green hydrogen plays, or renewable energy, your LNG, and obviously some oil exposure, as well as economies start to open up coming out of the COVID pandemic lockdowns.
Trent,
So,
No, I was just going to say, how long do you think this has to play out, when it's clearly linked to, we're obviously heading into the Northern Hemisphere winter, as we were talking about, but also obviously coinciding with the global reopening, plus you've got those ongoing supply chain constraints?
Yeah, absolutely. Look, I think we're probably going to see over the next 12 months, some relatively strong pricing across coal, oil, LNG. It's really a question of when, obviously, like you said, but it's quite hard. I think demand was so pent up during the lockdowns because no one was focusing on increasing more supply, particularly not OPEC, because we didn't know when economies would be opening up. And then we'd be sort of in the case of, an oversupply in oil. So I think that's the key question. It's the burning question. We don't have a crystal ball in that aspect, but I'd say over the next 12 months we'd see some strong pricing across those three in particular.
Trent, thanks for joining us from Barclay Pearce Capital.
Thanks for your time.